Hello everyone. Let me begin with the monetary policy review update. We saw a status quo by the Reserve Bank of India in the 6th bi-monthly monetary policy review, where the repo rate was unchanged at 7.75. This was broadly in line with our expectations as also the consensus view. It was very evident given the fact that we saw an out-of-policy rate action on Jan 15th, which took the overnight repo rate from 8% to 7.75%. The surprise element in the policy was a 50 basis point cut in SLR, which obviously was not, in terms of timing, was a little bit of a surprise, which would mean that about 40,000 odd crores of liquidity would be available from the banking system to the credit sector. That took the markets by a little bit of surprise, which is why we saw the yields back up a little bit. So the 10-year benchmark sovereign bond backed up by about 7 to 8 basis points to currently be trading at about 7.72%. It is our belief that the SLR in the banking system is way above the mandatory 21.5% right now. Hence, our take is that the SLR cut is more of a symbolic gesture. The liquidity in the system with this SLR cut would be a bit better. Additionally, the RBI has also committed to maintain liquidity fairly comfortable in the system. So if at all there would be outflows on account of spectrum and coal auction payment, we do not expect liquidity to substantially deteriorate from the current levels. The shorter end of the yield curve could obviously move up a little bit in response to tight interim liquidity, maybe back up by 15 to 20 basis points. Additionally, the monetary policy review, the RBI decided, or the RBI has given a guidance that FIIs cannot invest in corporate bonds under 3 years. That also would have a small impact at the shorter end of the yield curve. But if the broader belief is that the rates in the system is overall going to come down, we expect these measures to be likely temporary in nature. Our take still continues to remain that if RBI has guided us towards a monetary easing going forward, the environment continues to remain conducive for that. It is very critical to watch the incremental set of CPI numbers and, more importantly, the mother of all events, the budget, which will be tabled at the end of this month. So it's very clear that RBI would likely continue the rate easing process in India if they were to be convinced that the disinflationary process is for real and the government will walk the talk on fiscal consolidation. We believe that with global disinflation, India would not be an exception, and it is very, very practical to expect the Jan 2016 RBI's CPI target of 6% to be met at this juncture. Fiscal deficit front, we believe the government will not get into relentless spending, and it is safe to assume a very marginal slippage, but nothing significant which could derail the markets. On balance, we expect the 10-year to find a reasonable support in the band of about 7.75%. We continue to maintain the view that India could see another 50 to 75 basis points easing through this year, which could take the terminal repo rate to about 7% by end calendar year 2015 or probably by March 2016. Again, the view or the bet goes in favor of duration funds, which would give investors the better value for money deployed. If one were to play out the fixed income story, we would continue to urge investors, A, to stay invested in strategies such as Kotak Bond and Kotak Gilt, and B, continue to allocate more monies at the current or consolidating stage. We believe that fixed income investments of this nature would give a reasonably positive experience for investors over the next 18 to 24 months. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.